Good morning, everybody. Welcome to the Market Report brought to you by Mike Bjork, and happy Friday to you guys. It's Friday, November 18th. We got just really the leading indicators coming up for the month of October on our economic calendar today. And the last reporting back in September, we had a 0.2% increase of leading indicators, and October slowed up a little bit to 0.1%. So obviously leading into the fourth quarter, we want to see things improve, so we'll have to kind of wait and see if November improves for leading indicators, but not the greatest news, obviously, right there. We'd like to see a little bit higher number on leading indicators going into the fourth quarter. So let's take a look here at the headline news, and right now the stock market's down. It's kind of taken its toll after, since post-election, we've had a lot of rallies in there. Dow's been down the last 2-3 days now, finally. There's a lot of Fed speakers speaking today. That could also make the markets move a bit today as well. Stock market's kind of moving in. We've already had a number of them kind of say that they're for a rate hike in December's meeting. So, I mean, that's why the Fed funds projections are at 90% right now, that there will be a rate hike in December here, at December's meeting here. So let's go ahead and take a look here at the bond market. And yesterday we had a big drop in there. We're down to about if you didn't know, we're at the 3.5% coupon, because there's been such a big spike in the interest rates that we felt the 3.5 coupon is better view of where the bond market's at. And for a while, they look like we're going to be in the sideways pattern, but now we're testing this 103, which is a very important level here. And we had another price early in the morning here, because it just started coming down even further. We're down about 28 basis points so far this morning, and right now we're just underneath this 103 sitting around 102.75. So we want to hopefully close above that, so that way we can have this as our floor support and support us, so we can hopefully spring upwards and to recuperate some of the loss that we've incurred since the election here. And again, all this is basically concerns that there might be inflation. Janet Yellen had Congress talking about the Congress, how they want to maybe borrow more debt, and which will spike up inflation for the infrastructure buildings. So a lot of these plans that going forward are concerning that there might be inflation, and that's the enemy to bonds, which is what drives these interest rates, mortgage-backed securities. And that's why they've been trading these into buying either stock market, but now because stock market's also down, it's all going into the global treasuries around the globe. So that's why you're seeing like a lot of the Europes, when they're under negative, like even the Deutsche Bund, matter of about 60 days ago, about 2 months ago, it was like negative 0.2. Now it's about positive 0.2, 0.3% right now. And right now, our 10-year treasury right now is at 2.3 and growing right now. Whereas about 60 days ago, it was all the way down to about I think it was around 1.8 or so, around that range. So it jumped up quite a bit in that range on there. So a lot of this money is moving into places like the 10-year treasuries, and which is kind of hurting from us. And speaking of such, sometimes when you talk to some of these mortgage people or all these people that are misinformed, and somebody's been in the business for a long time, that when you talk about interest rates, what do you follow to help gauge interest rates? Some of these people will tell you the 10-year treasury is what will tell you, where this follows the 10-year treasury, and that's not true. In this scenario, this goes in the opposite direction. If you follow the 10-year treasury, you would be out a lot of money in this scenario. As you can see, the bond market's going downwards here, where the 10-year treasury's been going upwards. And if you're following the 10-year treasury, again, you would have had a pretty big swing in difference. This is one of the biggest illustrations I think we can come to, that the difference between a 10-year treasury and the mortgage-backed securities, that 10-year treasury is not the one to follow in terms of interest rates for long term here. So if you're talking to somebody, you might want to correct them or just simply run, because obviously they don't know exactly what they're talking about here. As you can see here, the chart's interest rate has been climbing upwards. Meanwhile, the 10-year treasury has been climbing upwards, and mortgage-backed securities are climbing downwards. So when you don't have the supply or demand for the mortgage-backed securities, the interest rates go upwards because there's a lack of demand for it. All right, folks, you guys hopefully you guys have a great weekend. But if you guys want to keep up to date throughout the day, just go ahead and follow me at Twitter at Mike Bjork here, and hopefully see you there as well. Otherwise, we'll see you guys on Monday. On Monday will be a short week. Thanksgiving, the markets will be closed, and they'll only be up for a portion of the day Friday. But I'll be out of town for the weekend, for the week, so I won't be posting on Thursday or Friday. So we'll have to wait till so my final one next week will be on Wednesday. All right, have a wonderful weekend. We'll see you guys on Monday. Take care. Bye-bye.